Just wanted to say hi. Just wanted to say thanks for coming out. My name is Barry Mathis. Can everybody hear me okay? Do I need to get a mic?
You're good.
You're good? Okay. My dad was a Pentecostal preacher. And so if I start running up and down the aisles, it's just because I got excited, right? So wanted to touch base and just talk with you guys for a little bit today. I've been doing real estate for about 18 years. I've done a lot of different types of real estate. I really never learned that. I had someone tell me one time you should specialize. And I really never learned specialization. I just never focused on one thing. I did a lot of different stuff because that's one of the things I love about real estate is the fact that you're not put in a box. You can wake up today and do whatever you want to generate business for yourself. And I love an opportunity where I'm rewarded for the effort that I put forth. And I'm sure that a lot of you are the same way. You wake up and you do more than what other people do, so therefore you expect to be compensated more than what other people are compensated. So that's an environment that I've been in for the last 18 years, and I've loved doing that. Over the years, I've owned a brokerage, or 2 or 3, or 4 even, I think. I had an Intero franchise. Any of you familiar with Intero? That was a, you said, oh yeah, are you from Intero?
No.
Okay.
No, but there's an Intero here in town.
Okay, so I had an Intero franchise in Sacramento, and did that for a while. Really loved Gino Buffari and what he built with Intero. That was a great organization. After that, I was with Keller Williams. Before that, I was with Remax Gold. I've done my own brokerage as well several times. Did a property management company. Really learned a lot about working with investors when I ran a property management company. Had about 300 properties that we managed on a regular basis, so we were putting about $250,000 a month through the account, and so that was a lot of rent and a lot of investor contact there. So over the years, I've just done a little bit of all that. Done a small commercial, some office, pretty good deal of land. Right now, I'm currently a producing agent as well, working on a brewery. That's kind of fun. I've never done a brewery before. So I'm working on a brewery right now, helping them build that and get the land for it. So I say all of that not to say that, not just to toot my horn, but just to say that's where I came from. Those are the experiences that have given me the understanding of the investor mind that I have. I've flipped properties, probably 36 properties personally, bought a lot of buy and hold stuff for clients, and owned some rentals for myself. So it's given me a part of real estate that I really love. One day I woke up and I realized that about 15% of my clients produced 50% of my income. Now that was a big revelation. I mean, we've all heard of the Pareto principle. We've all heard of the 80-20, and we've applied that a lot of times to real estate agents. Production. High producers produce a lot more than low producers do. In real estate, there's never another industry that's not true more than in real estate. The average real estate agent sells about 6 homes a year. Those are the statistics we hear. Yet, you probably know at least one person that does 100 homes a year. So that's crazy. So the Pareto principle in my market is actually a 70-30. About 30% of the agents produce about 70% of the business. So you need to come to grips. If you're new in the business, I talked to some people that were newer, you really need to come to grips with that and understand 70% of the agents are people you don't want to model after. Only 30% of the agents that are in the industry are people that you want to model your career after. So find those people and get close to them. Always be learning. And so what I'm going to do today is try to give back to agents and give back to you what I've learned over the years. And so that's something that I can do because I feel that I've learned this and it's really helped me in my career. When I started realizing what helps me sell 50 homes a year versus another agent that only sells 6. And it kind of sneaks up on you. You don't really start out going, oh, I'm just going to work with investors. Because if you did that, you'd probably starve, right? You got to work with friends and family and whoever comes along. But as you start to work with some investors, you start to be drawn more and more towards that. So I'm going to try to influence you earlier in your career for some of you, and then a reminder for some of the others who have done more real estate than I have in the room. And a reminder for you guys to really focus on that if that's something you like doing. Everybody okay with that?
Yeah.
Anybody have any questions before we get started? Okay. So can everybody see? Am I on your way? Okay, good. All right, so working with investors. Why work? I've already given away some of the juice here. Repeat business. Is this better if I turn this light down, guys? Does that be better for you? All right. So feel free to stop me as we go through. We're not really very scripted. I'm kind of off the cuff. I used to do a radio show where people just called in and asked me questions, so I'm totally fine with that. Repeat business is the number one reason why you want to work with investors. I've got a client who has done 9 transactions with me over the years and referred 4 more. His name is Mark Cantrell, and Mark has done a lot of business with me. Mark is not a hedge fund. He's not some big corporate dude. He's just a private investor that, in his case, has flipped quite a few properties, done some commercial properties, and then what you find is people like that also know people like that. And so they refer people to you that have been, some of my higher transactions were from referrals from him. Clients that listen. Have you ever had a client that just wouldn't listen to what you're telling them to do? Anybody? Yeah? So you got a client and you're telling them what to your knowledge is the very best information you could give them. And they just refuse to listen. They do whatever they want, right? You're going to find that working with investors, it's not so emotional. It's still emotional, don't get me wrong. Investors, they love their money, you know, but it's emotional for different reasons. And when they're not listening to you, it's for a different reason. It's not because of something that you've said in the past or they've experienced from the past, most likely. It's probably because what you're saying to them, if they're not listening, is they don't fully understand it. Because the thing about a true investor is, he's going to understand why you're telling him what you're telling him. When you lay it out correctly for him, a true investor, and I say he, it could very well be a she as well, a true investor, though, moves to the right answer. They don't stay stuck on an answer because that's just how they feel, right? When it's fully explained to them. So if they're not moving to the goal, it's because you probably haven't explained why they need to move in that direction. It's usually a misunderstanding rather than something other than that. Purpose-driven. So let me go back to clients that listen. Had a client, his name was Peter Hunt. Peter and his wife are landscapers. Peter Hunt had a self-directed IRA. We'll talk a second or two on that later. But they had a self-directed IRA. They had never done any investments on their own, but they did go to a seminar, and they got themselves a self-directed IRA. We started out, they bought a condo for $25,000. So they used that first condo, they flipped that, they sold it, then they bought a more expensive condo. And then they bought another condo. And then they became a private investor to me on the flips that I was doing. So instead of doing the work themselves, they got busy with the landscape company, and so then they just loaned me money. So you're going to meet all those opportunities, but they listened from the $25,000. Do you think they were grateful that somebody would help them at $25,000? And when I helped them at $25,000, do you think they showed their loyalty, because at the end of their third deal, they wound up just giving me their money, right? So that was a great opportunity. Not all of you will do flips yourself, but if you do, you might go, well, how do people get the money? Because they prove their value to someone over the years. They earn that right to earn that trust. Purpose-driven. So I am involved in my church. Church has a big meaning for me. I'm not always the best saint, but I strive every day to go back to what I should be doing. And so, to me, I was raised in a Pentecostal family. My dad was a preacher, but we never had any money. My dad, I remember him getting paid in Mississippi church that he preached in. As he traveled and preached, so he wasn't at one church all the time. I remember him getting paid with pottery. The people in the church didn't have money, and they gave him some pottery. And that damn turtle stayed at our house, and I hated that turtle because to me it represented that they didn't appreciate what Dad had done. Now, I grew up later and learned that they didn't have any money. But when I was a child, that caused problems for me, that little turtle. But purpose-driven, I have since then been able to help pastors that really don't have an income to speak of. They don't have, most churches, not your big mega churches like the one I attend now, but most churches don't have 401ks. They don't have retirement plans. They barely have medical in some cases. Most churches, the preachers and pastors and staff are just surviving. And so I've been able to take those pastors and help them buy properties that now their wife has income for the rest of their life if they choose to hold on to that, right? So the pastor could pass away, the wife's still getting that rental every month. So that's been a great thing in my life. I've liked that purpose-driven aspect of it. All right, so the biggest cost that you're going to face is a customer acquisition cost. This is something all industries recognize. This is not unique to real estate sales. I was speaking earlier to, was it Rob? Was it Rob? Yeah, that has the solar industry background. So the solar industry, this is another business that handles sales as well. And this is the cost of acquiring a new customer. And so you need to understand what that is for you and your company. You may not know it exactly because it gets kind of milky for real estate agents. With another company, another type of company, it's pretty clear. They take their marketing budget and their sales budget, and they combine those together, and that becomes their cost. And they look at how many clients, that's their customer acquisition cost. We're not going to go into a lot of details because it's very different for each one of you. But when you're looking at that number, what I want to point out is you need to include what you pay yourself. Okay? And I'm not going to give a lesson on this right now, but if you're making about $75,000 a year, you need to not be working as a sole proprietor. You need to have an LLC and pay yourself through the LLC. And get with your CPA to get more detail on that. But if you're below $75,000, don't spend the money to do it. At least that's my opinion. I will share many things with you that are just my opinion. Feel free to throw them in the trash when you leave the room. Take what you like with what I say and use it, and if you don't like it, call me, I can explain it, and if you just still don't like it, then just ignore it. And so, customer acquisition cost by industry, as we said before, this is something that a lot of people are going to, a lot of industries use. And so this has real estate as the third highest. I believe that number is much higher if you count the salary and things like that. I think that this is not really counted the same way we would for our own business. So one of the things that really is important here is this note right here. The customer acquisition cost climbs rapidly if your leads require human touch. And I don't know of another business that leads require more human touch than the one we're in. You are all about human touch when you're selling houses. And that's true for investors as well, all about human touch. And that's why that cost of acquisition zooms through the roof. What we want to do in the model of working with investors is you really need to move your mindset from a selling mindset to a teaching mindset. So again, I want to remind you that I'm not talking about working with corporate investors that, BlackRock is not going to call you up and have you manage their portfolio for them. What I'm talking about is your existing clients that are already in your database, that you've already sold a house to. Have you ever talked to them about maybe they want to buy a rental? I'm talking about the person that is they want to start investing, but they don't know what to do. That's what we're going to teach you here today, is how to get those people off the fence and into action. And that's what is probably, if I had one gift I think that makes me different than others, is I have that ability to get people to take action. And not in a manipulative way, but in a teaching sort of way. So when you're selling, every interaction is measured against profit. So you wouldn't go help the person that only had a $25,000 transaction. You wouldn't help them. But I'm looking at the lifetime value of that client. I'm not looking at that one transaction. When you're selling, you make people fall in love with your product. So you're trying to push a house. One of the surprising things, agents that I've taught over the years, one of the most surprising things to them is that they're not actually selling houses. And I think you all probably realize that. You're selling yourself to the people. The house either sells itself or it doesn't. I don't talk people into buying houses. I talk people into using me to buy houses. The house sells itself. They either like it or they don't like it. With investors, there's some other factors that go into it, and we'll talk about those. But for the most part, that's true even with investors. You create a hoarding mindset. We all know that creates problems in your life internally and spiritually and other ways. You want to have a generous mindset. Uses industry jargon to overwhelm. So a lot of times people come across real showy and arrogant. They're trying to use, and they use all their knowledge and they throw all this jargon out there. You'll hear some jargon as we go through this, but I want you to let me know if I'm not explaining it. And it focuses on the need of the salesperson. In our industry as salespeople in real estate, we often use the term business model instead of need, right? So when your business model is not set up to benefit the client, then that's a problem no matter what business you're in. And you will eventually have problems with that model if it's not set up to benefit the client. So you often wind up using manipulative tactics, either pressure or fear, in order to get people to take action. And that's definitely coming from the wrong place. When you're in a teaching mode, it forces you to look at people as almost like a partner with you. So teachers don't use those sales methods. Teachers don't have the same reputation as salespeople do because of that. Teachers provide value regardless of the student's response. You see teachers working with kids, maybe your high school kids aren't all perfect, and they sit in class and the teachers are going to continue to teach even if the kids don't respond very well, because you don't know when that's going to kick in for them. With young people, sometime in their life it kicks in, but it may not be the first time you talk to them. Softens our approach. It really, Nordstrom says that they spend a lot of time training and they're known for their customer service. They use that term guest instead of customer. So if you go into the high-end hotels, you'll see the same thing at the Ritz-Carlton. You'll see that they use the term guest, not customer. Why? Because it psychologically makes you treat them different. So when you're thinking clients, think guest or student. When you think clients, think student. You know, when you're working with these investors, you're trying to teach them something. And it changes the way you think about them. It gets you away from that dollar sign in your eyes every time you see them. When you're teaching, it makes people fall in love with you. It really does. When you help somebody do something, they're just very grateful for that. I've got people over the years that I've helped in real estate. I've got people I've helped in investing. And they're always grateful for that. They treat me differently. And I tell you, I'm not always a perfect person. I need all the grace I can get. And so it's good to have that trust that's built up. Creates a generous mindset. When you use industry terms, it's because you don't want to not use them. You want to use them, but you always want to explain them. Because most industry terms in investing, they actually aren't just terms. They actually convey principles. So industry terms on the investing side really need to be paid attention to because there's some underlying bedrock principles that come into play when you start discussing those terms. And you focus on the need of the student, not on that. So let's go into, how many of you have read this book, Todd Duncan's High Trust Selling? I'm going to throw out a couple of books here every time, as I go along. These are all books that you should read. You're now grown-ups and you're responsible for your own education, right? And so this is a great book, High Trust Selling. And in a nutshell, that's what the book says, is switch to a trust mentality, teach people, be a consultant instead of a salesperson. All right? One of the things, right in here, this book is forwarded by John Maxwell. How many have heard of him?
Yeah.
And it's endorsed by Ken Blanchard. How many have heard of him? 1 Minute Manager. Brian Tracy. Anybody heard of him? Wrote a book on questions, asking the right questions. Tom Hopkins and Zig Ziglar. Everybody heard of Zig Ziglar? The gray hairs raised their hand. Zig's awesome. Was awesome. And Kerry Hyden with Wells Fargo. Has anybody ever heard of Kerry? No? You know why Kerry's name made it up there? So this is on his jacket cover, right? These are right off his jacket cover. Why did Kerry's name make it up there? Because Kerry was president of Wells Fargo. They bought copies of this book for everybody in the company. So I think I'd put Kerry's name on the front, right? So the exposure. So I stopped that for a second because I want you to see all of this name recognition. You knew all their names. He got them to endorse the book. It's a great way of selling. This works in sales for you as well. And then Kerry Hyden was what we would call a partner, a referral partner. And so that really helped him launch that. So watch those tricks. And the other thing is, on here, there's a little sticker on the front. Can you see the sticker? Right here, there's a sticker here. It says, increase your sales by at least 20% in 12 months or your money back. What would we call that in real estate? A unique selling proposition, a USP. Have you ever heard of that term?
Yes.
So that's what you'd call that. And it's just kind of interesting that even in a different industry, Todd Duncan is more in the loan industry than in the real estate industry, but you'll see that. So I just thought I'd pause that for a second. I love good salespeople wherever you see them. All right, owner versus investor. There really is a different mindset for an owner versus an investor. They do things a little bit different. One, an owner-occupied home, they'll own 3 to 5 homes over a lifetime. So over the lifetime of working with them. And so you remember we went back to customer acquisition cost. The customer acquisition cost is calculated over the lifetime value of that client, not just the single transaction. So all customers should be treated as if they have a higher lifetime value than just that one transaction. And you'll find that they do. They come back around. You ever see that agent in your office that just looks like he gets a new listing every week? It may not be because she's the best agent in the whole world. It might just be that she's been around for 40 years. Right? So now people that she sold houses to when they were getting married are now having grandkids. It's just been they really get that repeat business. All right, the average rate of ownership is falling. So we've known this in California for a while. The average rate of home ownership is dropping. Now in California, it's around 55%. It used to be a good deal higher than that. Those are millions of homeowners that aren't in your client pool anymore. Average net worth is $195,000. The average age is 55 years old, and they've been in that property for 14 years now. That number used to be 5 to 7 years that they stayed in a property. that has been changing over the years. A lot to do with the markets. That's a whole nother class. I'm not going to do that one. Shannon, could you call Brent outside, please? Thank you. 33% are first-timers that never owned, and 74% would refer their agent. So that's pretty cool. 74% would refer their agent. That's awesome. However, only 70% can't recall the name of their agent after 1 year. So I've always found that kind of interesting. Okay, so an investor will own 2 to 3 homes at a time. So obviously more transactions. How many investors are out there? It's really hard to get a number of that because investors are really independent. But here we see that 7.1% of all tax returns are investors. They have rental income on it, or property income on it. And that's 10 to 11 million people. So your client pool is smaller, but they're very specialized, and it's worth going after because they'll own a lot more houses. And it's also increasing. So when you saw the rate of ownership falling over here, it's increasing over here. From 2009 to 2011, 23% more investors that own properties than there were in 2009. We estimate, again, these numbers are kind of cloudy, but I think this is pretty close, probably within 10%. We estimate there's about 48.5 million rental units in the United States, and about 200,000 homes are flipped each year. 28 million owned by less than 1 million entities. 25% of those entities, they pay cash, and 51% put down more than 50%. So these are high net worth people, but they may not be who you think. In our minds, we tend to get this picture of a corporation. In reality, this is a plumber who's worked all of his life plumbing and needs to put that income somewhere, and he's been conservative with his money. There's another book that I didn't bring with me. Oh, yes, I did. Chris Hogan, Everyday Millionaires. This is out of the tribe of Dave Ramsey. I'm an ELP. This is out of that tribe, and this is a great book on everyday millionaires. The millionaire is not the person you think it is. It doesn't look like the same. There was another one called The Millionaire Next Door. That was a great book. Get the revised version that's been updated. Those are great books to kind of give you a picture of who your client is. 76% are under 55, and 33% plan to buy again in the next 12 months. Mind you, that's not the home they are living in. That's just another house for them. Why do buyers buy? Maslow's hierarchy of needs. I'm not going to spend a lot of time on this, but you can kind of get the idea. They have physiological needs. They need shelter, safety, better neighborhood, love and belonging. Some people say that's social status that they need. Esteem. This is status or a job. They may have got to move. They may move moving up in income. I talked to a guy the other day, and he just went from making about $50,000 a year and never really having a chance to own in California, and now all of a sudden he's making $150,000. Let's go shopping for a house, right? So that's pretty cool. He never expected it, but he's got it. Self-actualization. I'm going to have a hard time saying that. Somebody say it for me. Actualization. There you go. Sounds better in unison. All right. Really, household formation comes under that. You know, you're young people, you're starting out. We're still forming households. Young people are still connecting, even though millennials kind of took a late start to do it. But we've got studies that show they want a house just like everybody else. They just were a little late bloomers to get to it, but they want it. Why do investors invest? To make money. I mean, that's why you would invest, right? Remember that. Why you would invest is why they would invest, right? They're not different from you and your desires and your needs. To provide for their ongoing expenses, to build wealth for future retirement, to leave a legacy for loved ones. That term legacy has a lot of different meanings to different people. Stewardship, different meanings to different people. But they all are going to do it for some of those reasons. And you need to understand what reason that they're doing it now. Because it's not like working with a buyer. A regular home buyer is buying it because he needs a place to sleep at night. An investor, remember, one of the best rules I can teach you about investors is they don't have to buy anything. Nothing. They have no need to buy. They can put their money in the stock market. They can put their money wherever they want. They can keep their money in their pocket. They don't have a need to buy unless you give it to them or they've already arrived at that conclusion. So you really need to understand if they understand the need of why they're buying. If they can't express that need to you in one of these terms, then you might not have a real investor. And in talking about investors, one of my best friends sells more real estate. I think his team was at $100 million a year. And he always told me, don't work with investors. Matter of fact, he refers his investors to me. He's quit telling me that now. He's known me too long. But he's always told me that because they don't have to buy. You wind up spending a lot of time with them. You can waste a lot of time with investors. So what you have to get good at is the language I'm gonna try to give you during this time, our time here together, is to help you understand who's a real investor and who's not. And that's probably the biggest. If you can walk away here and understand how to read somebody and get a good idea of who's an investor and who's not, that would be the best thing I can do for you. Okay? Would that be helpful for all of you?
Yes.
All right. All right, you got to learn to ask the right questions. I don't have his book with me, but Brian Tracy is the master of that. I once hired Brian Tracy to come. It was a great event. He told us this story about trying to get people. His talk was going over very flat, and his story was basically that he'd gone to Canada, and he couldn't get these guys to respond to anything he was doing. And he figured out, he talked to them on the break, he said, these guys are just dead. What am I doing wrong? And they said, well, you're talking about ambition and motivation. These are all union employees. They're not getting motivated for anything. So asking that question helped him get to the right spot, so he knew how to change his talk. It also makes a difference between us. We're entrepreneurs. We're going to find that motivation. We're going to do it ourselves. What are your goals? This is something you need to be asking these clients. What are their goals? What's your time frame? What type of investing are you interested in? What have you done in the past? Did that work for you? These are not casual questions. Someone heard me one time at an open house, and they said, you're asking them questions. It's almost like you're qualifying them. I am qualifying them. It sounds like a question, but I'm qualifying them. I may not be running them to my lender, but when I'm asking them these questions, I'm very much qualifying this investor. What type of returns do you get on your other investments? Everybody has an investment of something. Most people that are investing in real estate also have some money in a 401k. They also have some money in retirement. What kind of returns are they getting? Open them up and get them to talk to you about those numbers. What resources do you currently have? By resources, I mean money. Okay? And I even say that. I'll ask them that question, and then I'll put a smile on my face. By resources, what I mean is money. Because they'll start telling me a lot of things that aren't money. What do you need to get access to those resources? What I'm looking for there is a code word. I'm gonna show you in a little bit the sounds you don't want to hear, but right there, that's a very important question. What do you need to do to access these resources? What would obtaining that goal mean to you? What are you willing to sacrifice today for your tomorrow? So find out what's motivating them. This should be a 20-minute conversation with them in an office environment, preferably, right? Let me tell you, if they won't meet you, you either haven't sold your value well enough or they're not really interested in investing, okay? My investors come to my office for the first meeting, almost every time. Not always, but almost every time. There's nothing that's every time in real estate. If anybody says it happens every time that way, you got to question that. All right, what do real investors sound like? You need to be listening for these clues. They ask outcome-based questions. Their questions are forward-looking. When they're asking you about stuff, they're asking you what happens after I invest, what happens in the future. They're not asking you so much about things that are in the present as much as they are the future. They're process-oriented. They want to understand the steps as they go along. This is not every investor, but most of them have that process mentality. They seek input and guidance. They're coming to you. They expect you to have answers. You better not just sit in front of them and say, well, what do you want us to go look at? You need to be giving them some answers. It's not like they're just grabbing stuff off the MLS like the general public does. You need to be helping them understand why, where, what, when. They're open to discussing financials. When you get that's a common misconception. I can't ask people about their money, right? Common misconception. People that are being investors, they understand that they have to have money to invest. If they're not being forthcoming with that question, you need to not avoid the question. You need to dig in a little bit harder because there's a reason, and we'll get to that reason in just a minute. They're future focused. Like we said earlier, the sounds of impending doom. What do I call impending doom? This is people that are trying to steal from my family. I don't know about you. Would you let somebody come in and steal from your family? If you could help it, right? It's one thing if they hoodwink you, right? But who's the professional in the room?
You are.
You are. You're the professional. If somebody takes advantage of you, it's because you allowed them to, right? With some few exceptions. I don't do everything perfect myself. I still get oh darn, I should have seen that coming, right? But I don't usually see the same thing. I adjust what I do. So these are some of the things I hear that makes my ears perk up. They'll say the phrase, I have access to unlimited funds. I'll be like, great, what seminar did you just get out of? Right? Because you know they just went to a seminar, and the seminar told them that if you go find a property, we'll give you credit, and you can buy with us, you just bring the property back to us. The seminar was total crap, it was total lie, they ripped them off, and they told them they had money and they'll never give them any money. No deal will ever be good enough for them. I'm ready to act, but just I haven't found the right deal. That one, you start paying attention to. It's not a red flag completely, but it's definitely orange. How long have you been looking? Well, 2 years. Oh, well, we need to get past that, right? I need to understand why you've been looking for 2 years. Is it because you just didn't have the courage to step forward? Great, I can teach you how to have that courage. Or is it because you're so picky, nothing's good enough for you? And usually, when that's the case, it's because they don't fully understand what they want. And when you can help them figure out what they want, that's where you can start a conversation. But I can't go show them property if they've been looking for 2 years. I'm not going to do any better than the other guy. I need to first figure out what they've done, or what's going to get them excited. I'm looking to make X number of dollars on each deal. That's a common one you'll hear, especially from newer investors. What it should be telling you is that they're newer and they're going to need some hand-holding. This should always be phrased as a percentage, not a dollar amount, right? I can make you any number in the world. If you tell me you want to make $1 million on a deal, I can definitely go find that deal for you. The only thing is, we need to be buying Grand Cayman Hotel in order for you to make $1 million. As long as I take the price tag up to $100 million, I can make you $1 million, no problem. So you see how it just doesn't work. Experienced investors will usually come back with you with a percentage. I want to make 10 to 15% on any deal that I do. Okay? And if not, you should be converting them. I have several agents looking for me. That's code for you ain't never getting paid because my mom has a license. Right? So you're going to do all this work, and then I'm going to go use my mom. Which is okay. I've helped people buy whose mom had a license. A lot of my clients are brokers themselves. But they know that I can get them what they want and I can handle that transaction, so they still use me. My partner and I, this is usually code for the person talking to you doesn't have the ability to pull the trigger. And you need to get in the room with that partner. There are a few times that I've had that phrase and the partner really did give them their blessing to go ahead and make the purchase. Usually what happens is that partner is related to them, the partner has the money, and they have the time and the energy to go looking. But you've got to get an understanding of who's making that choice, and eventually you're probably going to have whoever's making that choice in your car looking at property. Okay? With a few exceptions, I can say that I've had successful closes where the partner was money bags and never had anything to do with the property. That's very rare though. Usually it goes back to a seminar. The word wholesale is used in any sentence. So if they know what the word wholesale means, then that's usually a red flag that they've been to a seminar. And it's also a red flag they don't have any money. So you got to figure that out. Are you guys familiar with the term wholesale? Yes. And it's okay if you're not. I'll go ahead and explain it. I don't want to embarrass anybody. Wholesaling is basically when you lock up a property and you tell people that you're going to buy the property, you put a contract on it, and then you go out and find another buyer for the property, usually at a higher price, or you're a bad wholesaler. So you might increase the price $5,000 or $10,000 or $50,000, there's really no limit on it, and sell that property, the contract itself, to another person. You'll see this in the industry, is you'll see something that comes across as an offer, and it'll be marked as, what's the phrase? Yeah, it's not a contract to sell, it'll be marked as and/or a sign. On your contract, they'll write an offer and they'll say, Bob Smith and/or as a sign. Well, that's a red flag. I'm not going to take it as a listing agent because I got to figure out if Bob Smith's really the one buying the property, right? You do your clients a disservice if you take that. So the word wholesale. So what that usually means is they're going to turn around. The biggest problem you have with wholesalers, there are some wholesalers that do it the right way, but there's many who don't. The biggest problem you have with wholesalers is they normally are technically practicing real estate without a license. And most of them don't tell the party that they're buying it from that they're shopping that package, which in and of itself wouldn't be completely illegal, but they never had the ability to buy it in the first place. And that's where the dishonesty comes in, is they never had the ability, they took a property off the market and they didn't have the ability to close on it. So that's a big red flag right there. And usually you get that from seminars. The sounds you make. This is what you need to say. This is the terms that you need to be incorporating into your language. This is what the investors are looking for. These are their confidence boosters, right? I can show you how to get there. Really and truly, we're moving from a sales position into a consulting role and telling people that we can guide them in this transaction. So my past client had similar goals. If you recall, when I first started out, I talked to you about Mark Cantrell, who's bought 9 properties. Peter Hunt and his wife, the landscaper, who moved their properties up from low to high to low to high. That was really good. And then using those stories that you've had in the past, it's important for you to internalize those stories. Advantage and disadvantages. You're not for or against anything. It's just this has an advantage, this has a disadvantage. Every type of an investment has advantages and disadvantages. And so it's not necessarily what you would do, it's understanding what's making them tick and what's making them game for it. Here's a saying I quoted, and actually rare that you get this quote from 2 different people, but I guess you do. People often overestimate what they can get done in the short term. However, they vastly underestimate what they can accomplish in the long term. And this is a quote that I'll actually use in the sentences because I'm going to take them on a journey. And I want them to go on that journey with me. So these are real estate terminology. Any of these terms, I'm not going to spend a huge amount of time. Go ahead.
Are you giving us these copies of this, or would you take notes or pictures?
Totally fine. I always recommend that people take notes. They say that ideas are like fish. You have to stab them with a pin in order to get them to stick around. Yep. However, we will send out the slide deck to you. So we have your emails if you registered. And if you didn't register, just make sure that Shannon, there we go, that Shannon gets your card, and we'll get those out to you, okay? Thank you, Shannon, for doing that.
Of course. Thank you.
All right, and yeah, these are kind of hard to read too, I think. How is that? In the back of the room, can you guys read that?
Yes.
Okay, thank you. So these terms are all terms that you're going to become familiar with. It's not the purpose of this class to teach you these terms. I'll quickly run through them, but there's a lot more that can go on to these terms. We'll have other classes and some videos that you guys can come to at some point. But any of these terms you could Google, and a better explanation would come up than what I'd give you in this meeting. Does that make sense? Appreciation, equity, and cash flow. Everybody understands what those are. The 1% rule is a term that people use to say that your rental income should equal 1% of the purchase price. Debatable in California. 1031 exchange, you guys should know what that is. It defers taxes. Capital gains tax, you definitely need to understand capital gains and how that's long-term and short-term, the difference between long-term and short-term capital gains. And you probably should look up the current year's rates for taxes. Now, you should be familiar with that. You're not giving tax advice, but you should know what it saves somebody if they hold that property for a year versus if they sell it in 6 months. You need to understand that because they might not. I just closed on a transaction at the closing table is when the owner found out that they weren't going to pay taxes on their $140,000 they just made. They were really surprised and happy, but they had no idea. So don't assume the public knows what you know about taxes. Capitalization rate, we're going to spend a little bit of time on that one. Net operating income, internal rate of return, the self-directed IRA, and debt service coverage ratio. So these are all terms you should look up and know if you're going to work with investors. There's a lot more than that, but these are some good starting points for you. Okay? Don't mind your manners. You're working with investors. They want to be led. Okay? Led is a funny word. Lead, led, has a lot of different meanings. It's a cause by which an animal or a person, you cause them to go with the direction you're wanting to go. You're either holding their hand or guiding them with a rope. That sounds like I don't know which one works better with the client. I think the rope would really work better with the client. The hand seems to work with kids, but the rope might be what I'm looking for. It's a route or a path of access to a particular place. So you go in a certain direction, you're leading them in a certain direction. But it's also a noun. It's taking an initiative and an action. And it's a pronoun. It's something that we buy from Zillow. It's a lead. So there's a lot of different ways that you get that you can incorporate that. But in a nutshell, leaders lead. And you need to be a leader if you're going to be in sales. You need to learn to guide people along the path that they already have come to you, raised their hand and said, I want to do this. Now you need to help them get across that finish line. It's almost like a wedding planner, right? So a wedding planner's job is to make sure that cold feet don't stop that wedding, right? So she keeps everything moving right along. But the wedding planner would never think to get somebody that wasn't interested in each other and try to get them to get married, right?
Yeah.
That's a matchmaker, not a wedding planner. We don't really use a lot of matchmakers in this country. But that is something completely different. So it's the same thing with you. Don't feel bad that you're leading your clients. They want to be led. They raised their hand and said, I want to be an investor. You need to lead them at that point. All right? So you're just helping them get what they already want. Manipulation is trying to make them want something that's not good for them and pushing them into it. Selling is helping them get what they already want. We have a distaste sometimes for sales in our minds because of that. All right, leaders provide vision, motivation, they set the direction, and then they come in and correct the course if it's wrong. And that's something you do a lot in escrow. You say, hey, you know what? This one's not a good deal for you. We need to back out. You know, that's something where you need to use those leadership. All right, I'm not rushing. Anybody rushing in the room? I think the best way I figured this out was devoya, no provoya. I don't think that's close. But anyway, trust but verify. Some of you might remember that was Ronald Reagan's phrase as he was conducting the SALT experiment, the SALT negotiations. But this is what we're going to do. We really want to get AAA rated investors. Verify availability of resources. How much do they personally control? Oh, I've got all the money. I've got the money. We can go ahead and look at houses, and then I've got access to the money. Great. How much do you have? And you have to dig in on this question. Oh, I've got access to lots. What? How many dollars are in your bank account? Right? Which bank account? Can you show me a copy of that bank account? And so that's something you really got to take the time to do. If you don't listen to me on that subject, you're going to be with a client. You're going to be out there selling in properties, and when this happens, you're going to come back and say, I wish I had obeyed Barry. I wish I had heard and heeded that one piece of advice. It's not obey. I'm not in charge of you. You do whatever you want. But I'm telling you, I've learned that lesson the hard way, over and over again. And I just don't want you to have to learn it. Dig and get that. And nowadays, most agents, they're not going to take, our brokerage actually requires a proof of funds with every offer. So this is something that's going to come down the road. You have to have a proof of funds nowadays. And that letter that says it's a loan, but it's almost like cash, that's not good enough. Okay, you really need to understand what's there. Verify capability. If I've got an 80-year-old client, I'm not putting them into a rental property in South Sac. Right? I'm just not going to do that. It's a tough neighborhood. They're going to have some issues. They don't need to be in that kind of property. I may not put them in a rental property at all, where we're talking about it for 80 years old. But get the idea. Now, if you've got a guy, he's a carpenter or a plumber or something like that, put him into a house that needs some repair. You know, he can go a lot further with that. So understand what their skill sets are. Verify suitability, and that's at risk tolerance. You know, if it's taking every dime they have, maybe they shouldn't be investing yet. Right? That's the thing that people grossly underestimate. We were talking about on the way down here, the problem during the short sale crisis, when that happened a number of years back. Many people that lost their homes to short sales basically just walked away from a home that was perfectly fine, that they had the capability of paying the note on, and if they had just sat still, they would be back upside. But they didn't, because the market tricked them into thinking that it was never going to get better. So verify that risk tolerance. If they were sitting with a financial planner, matter of fact, if you want to get an idea of what this is, go try to open something up with a stockbroker. And they do a lot of needs analysis and risk tolerance, because they'll get sued. Why? Because they have a fiduciary. And guess what? You know that word because you have a fiduciary too. You need to be understanding their risk tolerance, a little more than we do usually as agents. Uncertainty is very expensive. This is true in almost everything. We fill in the gaps of our knowledge with fear. You fear what you don't know. That can come from people of different cultures. You fear them. Really, it's just that you don't know them. We see it probably most often in real estate. We see it with repair requests. I got a client right now that's telling me that, it's going to take $40,000 to fix that. Well, they've never tried to fix something like that before. I know it's only going to be about 20. I'm not afraid of that repair, right? So people often overestimate that stuff. Uncertainty consumes your most valuable resource. Whether you're working with somebody that's not really qualified, in that case it's you that are uncertain. That takes your time. Then when you get into transactions, if you didn't plan for it right, if you didn't give them good estimates, if your numbers are off, if you're not sure about the rent, if you're not sure about the repair request, that always consumes your time. Uncertainty causes qualified clients to pass on opportunities. You got a client that's passing on things that you've sent them, it's probably because either you're not certain of what you're doing, or they're not certain, they haven't internalized it, right? They either don't feel comfortable about the rent, they don't feel comfortable about what the cost of repairs are. There's something there that they're not feeling comfortable on. And you got to dig and find that out if they're not responding the right way. Uncertainty creates disadvantages to your client's fiduciary interest. That's another big thing. You're supposed to be looking out for them. And if you don't do the digging, if you don't understand it, then you're hurting your client. Most of the things we do in real estate, especially on the single family side, you're fairly well protected. Your broker's looking out for you. There's not a lot you could screw up even as a brand new agent because somebody's looking over your shoulder and watching that paperwork and things like that. When you get into the investment world, that can change a lot. There's a lot of things that you could do that would wind up putting your client in harm's way. The fear of loss more than outweighs the temptation of gain. Almost invariably, someone will draw back from the fear of loss more than they'll run to the temptation of gain. So that is a general rule in sales of all types. So what we're going to do, we take them on a path. We're going to take away that uncertainty. They're not moving forward, then we're going to go back to that reason for investing in the first place. Yogi Berra said, if you don't know where you're going, then you might wind up somewhere else. He was kind of famous for his sayings. And then Zig Ziglar tells us that if we help enough people get what they want, then we'll get what we want. All right, so now we're going to jump into the numbers. How do I tell somebody how they're going to get what they want? First, I had to find out what they wanted. Then after they find out what they wanted, I go to this. This is the rule of 72. How many of you have heard of the rule of 72? Okay, so about half of you. In a nutshell, this is a real simple rule. It says that if you get a 4% return on your money, then your money will double in 18 years. If you can instead get an 8% return on your money, then your money will double in 9 years. Same thing for 12, well 6 years, and then what I'm usually shooting for is 15% and double in 4.8 years. That's usually my target for my investors. If your guy comes to you, another one of the red flags, if they come to you and say, I want to make 40% return on my money, you probably should go to the casino, not here. I don't think I can give you a 40% return. Okay? Although I can, but it's a more it's not what they mean. All right. So let's go back to that real quick. So if they tell me they've got $50,000 to invest, watch how I walk through this. $50,000 to invest, what's one investment cycle? It's going to double. What's it going to be at the end of that investment cycle? $100,000, right? So that's one cycle. Now we're going to double it again. We're going to go to a second cycle. Now it's going to be $200,000, right? The third cycle, it's going to be $400,000. Now it's starting to get interesting, right? $400,000 is going to double again. It's going to be at 8 cycle. At my fourth cycle, it's now at $800,000. Remember, all they had was $50,000. And now on my fifth cycle, they're at $1.6 million. $1.6 million, for some people, that's not a lot of money. For most people, though, at an 8% return, that gives you $126,000 a year for your income. So in a lot of cases, you've kind of won the game, right? A lot of people, that's the game they're playing. If I could just make $10,000 a month, I think I could live on that, right? So 1.6 million, you probably should be okay. That's 5 cycles, right? So that's why I'm tying that back to their goal. Does everybody understand what I did there? First, I found out why they're wanting to invest. And most of them, one of the common things is for retirement. And now I've walked them all the way through. Give me 5 cycles, depending on what interest rate we get, I put you there. Now you can quickly see that that opens up believability. One of the main purposes of this book is to let people believe that they can become a millionaire. The whole book, I summed it up in a sentence. You can do this. No matter who you are, where you are, you can become a millionaire. And what I just did for that client was I showed them how to get to their goal. Their goal may be bigger. I may have to use bigger numbers, but they may start with more than 50 grand. They may start with 500,000. Not uncommon at all. All right. What type of investing are they going to do? This is another big question, type of investing. So, the best time to buy, this is Warren Buffett. The best time to buy is when you have money, and the best time to sell is never. Warren Buffett is a famous buy and hold investor. He buys companies that he likes, he leaves the management alone, and he holds them for long term. So, the pros of a buy and hold. Does everybody understand what I say when I say buy and hold versus fix and flip? Okay? So, high returns over time. Less time-related pressure. You're not on an extreme schedule. Steady passive income. as much as anything, is truly passive. And you get leverage at your side and tax benefits at your side. Those are two big important reasons. All right, the cons. You're exposed to market conditions over the long term. So markets go up and down on a cycle, and everybody that was in the market with 20 or 30 rentals got hurt when the market went down. If you were in, it wasn't because you bought the wrong property. For some people, it's because they over leveraged. But the fact of the matter is, if you were in the market, you lost money. But that's just part of being in the market for long-term conditions. Management duties. You got to either do it yourself or hire it out. One of the two. As we know, tenants, toilets, and termites. You know, that's the 3 T's of being a landlord. All right? Fix and flip. So Aaron, we'll get into this in just a second, but Aaron is I'll tell you this, number 365 is a podcast episode. You can go broke buying good deals. Fix and flip guy. Aaron's done 1,000 transactions. Aaron didn't change his business model. When Blackstone came in, Blackstone and Invitation Homes and those guys told him, we're going to put you out of business if you don't change. And he said, I'm pretty tough, I'm pretty good, I'm doing 1,000 homes, I'm pretty good. Nope, they put him out of business, right? Pros, instant cash, less market exposure, less people-based problems. But guess what? Now you have more property-based problems. You bought this house, you got a great deal on it, and every wall you open up, you got to go in and rebuild, right? I've done that one. Every time I opened a wall, well, let's redo that wall. If we redid that one, oh, got to redo all the studs. I mean, it's just terrible. More capital requirements. You got to have a lot of cash on hand. Buy and holds, you could leverage that money. You could get a loan for 75% of the property for the most time. Here, your property-based problems, you got to have more requirements both to buy the property, a lot of times in cash to get that smoking deal, and to fix these problems, that repair bill. More taxes. If you're doing this quick and you're doing it fast, which really is about the only way to make money if you're going to flip properties, you got to be in and out. You got that short-term capital gains. This issue here, have any of you ever heard of a term, BRRRR? BRRRR? Anybody ever heard of that? It's BRRRRR. And that's not just because I'm from the South, right? So it's buy, rehabilitate, rent out, refinance, repeat. Buy, rehabilitate, rent out, refinance, repeat. It's called a BRRRR. That strategy really became around just because, a lot of it was because of that term right there, right? And that's on Bigger Pockets. We're going to get to that in a little bit. That's also where that number 365 is a podcast you can listen to. I highly recommend everybody listen to Bigger Pockets on a regular basis if you're going to work with investors. There's no way anyone you know, anyone in your office, anyone you'll ever meet can give you as much information as Bigger Pockets will give you for free.
Excuse me, sir. What was 365?
365 is the episode that Aaron of that podcast. Sorry about that, I wasn't clear. That's the episode that Aaron's story was on.
And that's on YouTube?
On Bigger Pockets.
Bigger Pockets.
BiggerPockets.com. You could probably catch them on YouTube as well. I think they do it all on, anyway, so it might be on YouTube. I'm old, I just use iTunes. So it's on iTunes. You go to iTunes. Okay? You can actually get a membership at BiggerPockets.com. I don't make any money off of that, but you should get a membership there. It's great. Cool. Property types. All those terminology I talked about earlier, they go into extensive stuff on those terminologies. Property types. We're going to get into some actual investing stuff here. Single family residence, condos, duplex, triplex, quadplex, also known as fourplex, threeplex, twoplex. All right, land, developer, builder. Multifamily, garden style. Garden style and mid-rise. You know, garden style is spread out. Usually they're not very big complexes because it's a lot more expensive to do garden style. You probably won't see any new garden style. They're almost always building mid-rise or high-rise now. So garden style is about 30% of the market, mid-rise is about 50%, and high-rise is about 20%. You're probably not going to work with either mid or high for the most part. You might occasionally, but most of the stuff that we're going to run into without getting into corporations is going to be in the 20 units and under. It becomes commercial after 4 units. You have to have on-site management after 16 units. So those two cutoffs are kind of key points. It matters after that. Commercial, triple net, office, retail, industrial. Again, I'm not teaching on that right now, but I want you to understand these terms. Your clients are going to be interested in these, okay? Asset classes. So earlier we talked about getting those rates of return. So return is a function of risk and reward in any industry. It's true for stock market. It's true for this. Stock market, a little bit different because they factor in, when they look at earnings in the future, they're factoring in the reward side, right? When you look at risk, you're maybe saying that company has too much debt. So risk reward is always part of it. Each of those returns that I talked to you earlier about have a different set of rules that go with them, or a different commonality of why people invest in them. They also, it's basically the same thing as a stereotype though. We know that a lot of stereotypes are true, but we also know that there's exceptions to every stereotype. So just because I'm telling you these numbers doesn't mean, oh, Barry's wrong because I have an 8 cap and I'm not over here, right? So that cap rate, what is the cap rate? I talked about that one earlier. It's important for you to know it. The cap rate is the income a property produces divided by the price of the property. And when I say income the property produces, I mean the net operating income, which is the rent that comes in minus all the expenses related to operating that property, net operating income. Then that divided by the price gives you that cap rate. Everybody understand that? It's a rough concept, and you can dig in a lot more if you just type in cap rate. You'll get plenty of sites that tell you that. Okay? The biggest thing that a buy and hold investor runs into is vacancy risk. It's the number one problem. It's the number one expense. Now, up here we talked about these prices, and again, every area is going to be a little bit different, but they'll kind of all run something like this. You'll have a single family house in a nice neighborhood, and it'll be nice and $300,000–$400,000. If it gets too high, you're not going to make any cash flow. So, by the way, you should not be buying properties that aren't cash flowing. I know it's popular to do that because you think you're going to get appreciation, but for the most part, don't buy a property that doesn't cash flow. Duplex, that's Warren Buffett's #1 rule of money. Anybody know what it is? The first rule of money, kind of like Fight Club, right? First rule of Fight Club is don't talk about Fight Club. All right. First rule of money is don't lose the money. That's Warren Buffett's first rule of money. Rule number 2, see rule number 1. So, same thing. Don't buy investments that don't cash flow for the most part. There's might be a few exceptions, but for the most part, don't buy it if it doesn't cash flow. It's an investment. Okay. Duplexes are going to run a little higher than a single family, sometimes twice as high, but because of the neighborhood, they're usually not twice as high. They're usually in lower neighborhoods than a single family would be. Fourplexes, again, won't be a complete double because, again, the fourplexes are generally in neighborhoods that are worse even than duplex neighborhoods. In 5 to 16 units, you'll find these all over the place. The prices can run anywhere from $1 million to $4 or $5 million, depending on where you're at. You can find each of these in good neighborhoods, and they'll obviously affect the price a lot. So generally, you'll see single family looking at 4 to 6% for a nice neighborhood, right? And you'd run that up higher for something that was in a worse neighborhood. And duplexes usually run around, in Sacramento, the official duplex number is 8.5%. So I create what's called an index, a duplex index. For me, the duplex is what I watch more than any other type. I measure everything off the duplex. So if 100 duplexes sold last year, I generally can access what they created in income, access what they sold for, and then I do the math on both of those, and I come up with the index cap rate. Now I don't obviously have the net operating income on all 100 of those, but in my experience, if you take out 1.5%, you've accounted for most common expenses. Okay? So I build an index, and that index is around 8.5% for Sacramento. For here, we'd have to build one for this model, but 8.5 is consistent for us. So you'll see in a fourplex, you get a little higher return. But what do you have in fourplexes? Maybe the quality of tenant's not as good. Maybe you got to deal with more. I got a phone call on the way down here from an investor saying, oh dear God, I got it to fourplex, and he calls it Baghdad. So I got a fourplex in Baghdad. Can you take over for my property manager because I'm not getting a call back? Well, I've been to Baghdad. I have to charge you, but you know how that goes. But that his fourplex, the reason he has it in Baghdad is because of this. Would you rather get 6% or 12%? Well, that goes back to the earlier conversations we had with that client about what their goals were. If they've got a goal of having that 1.6 million and they want to do it in 4 cycles instead of 6 cycles, then guess what? They can't be investing in Granite Bay or over here in Pleasant Valley. It's just too nice, right? They got to get to a worse neighborhood to make that kind of return. Does that make sense? Now you're starting to tie that together, why that conversation is so important, why showing them how to get there is so important. You got to tie it together. All right, 5 5 ways real estate investors make money. So number 1 is cash flow. Number 2 is equity growth, interest deduction, depreciation, and appreciation. Shannon, can I give you this real quick? Do you need this? Can you check and see if you need this? Our lunch is on the way, I think.
Okay.
You can check with Brent and see if you need that.
Okay.
Thank you. All right, 5 ways real estate investors make money. Cash flow, equity growth, interest reduction, depreciation, appreciation. Does everyone know what all 5 of those are? Right? Everyone know? No, that's the wrong way. Does anyone not know what all 5 of those are? Everybody close your hands, close your eyes, and raise your hands if you don't know after their eyes are closed. Okay, all right, all right. I don't want to embarrass anybody. Okay, so.
I have a question.
Yeah.
With the new tax law on interest deduction,
Yes.
what kind of effect does it have on investors now?
That's a great question. It affects only, I think there's certain limits that it goes to, but that affects, in my opinion, that's only affecting owners of property that live in the property. When you have interest on a property that you're an investor in, then that interest is considered a business expense. Does that make sense?
Yeah, it does.
Okay. Anybody, am I right?
Yeah.
I think I'm right. It isn't, that's good. That shows that she's keeping up with the law change. Your clients have that question too.
My
Right.
husband told me that.
Yeah, your clients have that question. All right, so what this is I'm going to quickly hit them. Again, this is something you need to learn, but it's not necessarily what we're doing today. Cash flow, obviously we know what that is. You get the rents in, you pay all the bills, you got cash flow. Whatever that is, it's going to give you some return on your money. So what return are we talking about? Let's say it cost you $20,000 to put that money down, right? To buy that house. $50,000 to buy the house, that's what you put down. But you've got cash flow above that of $5,000 a year. So 5,000 divided by 50, there's your return, right? Your return is not on the $250,000 that the house cost in that case. Your return is what you put down on the property. Does that make sense?
Yes.
So that's what you're measuring your gain against. Interest deduction, or equity growth. Your tenants are writing you a check every month for your rent. You're paying your mortgage with that. In the beginning, your mortgage is running about 70% of interest and 30% of principal. So every month, you've got 30% of your monthly payment is paying off principal. So that's where that equity growth is coming from. Okay? And at the same time, you've also got, working on that same number, the opposite side of that is that appreciation number, whatever is going up. If properties are going up 5% and you got a $500,000 house, then you just made $25,000 for that year. Everybody with me on that? Okay? You don't have to fully grasp this math. I want you to get the concept, right? Because if you Google this stuff, you'll get all the explanation you need. And then if you have any questions, anything, you feel free to reach out to me. I'll go over some of it with you. Interest deduction. The value of that interest deduction can be calculated for each of your clients. It can only be calculated as a rough approximation because you don't know all their tax returns. But the part you should learn is about what tax bracket they're in. And if you know about what tax bracket they're in, roughly what their annual income is, then you can figure out what that interest deduction is worth to them, right? So depreciation works kind of the same way. In residential properties, depreciation is 27.5 for you're allowed to depreciate that income. So you depreciate the property, the IRS says that the property is worth 0 after 27.5 years. Now we know that's not true, but on paper it's true. So they're getting to deduct that against the income of the property. That's one of the reasons why you see insurance companies own the most apartments out of anybody. Insurance companies hold apartments because of that right there. They're getting to depreciate all that income against other income as well. Okay? That's a big deal. So again, that's not the purpose of this, but these are guideposts along that journey. Remember that we're taking our client on a journey. The more we can walk them through this, on a typical investment that has 20% down and has an 8% gross return, like one of those duplexes, when I add up all my actual returns, I'm probably close to 30 or 40%. I don't usually lead with that number because they don't have a lot of times they don't have the concept to grasp that number, and they think, they do the same thing I do. Hey, if it's 15%, then that's too much return for me to expect. They think anything more than 15%, I must be lying to them, right? But in reality, a cash flowing property that has an 8% return roughly, cap rate, that you put down 20% on, you'll probably be collecting somewhere in the 25 to 40%, depending on some of these factors right here, is your actual return. Okay? It's not enough for me to tell them this. Just like you can't fully grasp this understanding by me just telling you, you need to learn to develop models like this that I can model it for them. Most people retain only a small amount of what they learn when they hear it. They retain a lot more after they get it as a picture. And in numbers case, numbers are not very eloquent. They don't really talk by themselves, and they're kind of hard for a lot of people to grasp, even if they do good in math. But they sing a language to some people. Some people look at them and go, ooh, you know, it sings a song. So getting this right here is something that I do for my clients. It's a simple spreadsheet that I created. It's very easy to do, but you just have to, all of these fields are variable over here, and these are the numbers they produce, okay?
Are we gonna get copies of this and maybe blanks?
Um,
What you produced or what you created?
I think I can do that. I can send you one. Yeah, I can do that. We'll attach it to the spreadsheet. You gotta have Excel.
You gotta what?
You gotta have Excel.
Excel, yes.
Yeah.
Of course.
Actually, Google has a free version of Excel too. I just never do it. I haven't used it. So,
Thank you.
yes. Google Numbers is their version of Excel, I think. And I think Apple has
Google
another
Sheets.
version. Sheets?
Sheets.
Is that Google?
Yeah, it's like the Excel version of.
And that's for Google, right?
Yeah, Google Sheets.
What's Apple's?
Oh,
Apple's has one called Numbers, I think.
I'm not
Yeah.
sure.
I think Numbers is Apple's and Sheets is Google's. You'll find that Excel is probably the most commonly used by any business person. If they're younger, though, they probably use Sheets. You know, they'll all do most of the same. The stuff you're going to do on them is not very complicated. The only thing that gets a little bit complicated is when you're doing an amortization table. But you can find those online as well. Any questions?
Thank you.
Okay. Sorry, did you get it?
Yes.
Okay. All right, let's see how we're doing on time. I think we're running right good. Traveling companions, who's going with them? So what you're going to do, remember we're taking on this journey, we're moving them along their journey to where they want to go, and we're helping them get there, and we're going to help them build a team. You need to have vendors in your pocket. You need to have a sheet of vendors that you can help them with. Remember, uncertainty is what the fear is. Uncertainty of how they're going to fix the problems. Uncertainty of how they're going to address this, that, and the other. That's the fear you're trying to overcome. So find 5 agents in your office that do a lot of business and ask them if you can get a copy of their vendors list. They probably have one, right? And if not, in this day and age, go to Yelp and create your own vendors list. Call 5 guys for each type of repair and see which one calls you back. Boom, there's your vendor. Okay? So I would prefer, though, that you get it from other agents in your office, because those agents know which vendors are good. Okay? And a vendor can make you look bad real quick.
Yes.
So I usually, the idea that I always refer 2 or 3, usually if I have a list, I'll usually have 2 or 3 on it. I don't really care about whether I get sued or not over because I only referred one person. To me, I have a fiduciary. I gave him the guy that I thought was best. That was my fiduciary. But I'm a fighter, so you might not want to do what I do. So, vendors support me, I support them. A vendor has a great way of making you look good, and then you need to stand by your vendors too. I use my vendors over and over. Sometimes my vendor relationships might be more important than my client relationship in some cases, because that vendor, I've used him for 10 years. I know who he is, I support him, and my client might say he did something wrong. There's some of my vendors I trust more than my clients, right? Familiarity builds trust. So as you become familiar with it, and as they become familiar with you and your vendors referring you, it's great. Toolbox. Let me give you some toolboxes that you'll need. In this case, I'm in Sacramento, but you could probably have something like this in whatever city you're in. And frankly, you can learn a lot just by reading Sacramento. Brian Lindquist runs this blog, sacramentoappraisalblog.com. You could go there, read his stuff, and then translate it into your market. It's not that different than your market. Property Radar. Every of you have heard of Property Radar. Okay?
I believe I have here, just here.
Huh?
I believe I have here, but
Okay.
just here.
This year, yeah, Property Radar is great. A lot of these sites, when you go there, you learn a lot more. They have a lot of ancillary sources that are there for you. Podcast. I already mentioned this earlier. Bigger Pockets podcast. Great podcast. I listen to that podcast anytime I'm on the road more than 15 or 20 minutes. They got 365 episodes, and I haven't heard them all. And almost invariably, everyone on that podcast has done more real estate than I've done. So I really want to hear that.
Can you go back one thing?
Yes, absolutely. Sacramento Appraisal Blog, and that's .com. And then PropertyRadar.com. Both of those are .com. Okay? And Real Estate Coaching Radio, you know, that's a good shot in the dark. Usually on a shorter trip, I'll just pop that in and let him yell at me for a little bit. That's basically what he does. Jim and Julie Harris. And Dave Ramsey, I don't know if you're into financials. Dave Ramsey's a radio talk show. I listen to him a lot as well. That's more on my personal side, trying to learn about investing and things like that. But I've learned a lot from that show as well. Real estate investment clubs. There's clubs in the area here. These are the ones that I go to. RIA has clubs all over the Bay Area, all over the nation. Capital City Wealth Builders. If you go to either of their websites, you should be able to find links to other ones. Go to meetups, meetups.com. I'm sure there's investment clubs in this area that you could go to, and you will learn a lot. Some of the things I've learned the most has been at these clubs. David Granzelli runs NorCal RIA. He's referred clients to me. At NorCal RIA, when I go there, I'm usually in a room that has maybe 8 times more people than this, and probably about 14 of them are my clients. 14 in one location. That's a great return. I don't know about you, but I like going where 14 of my clients are. All right? Intero, why I gave up. So that's pretty much the event that we've done for you today. I'm going to give you the websites. I'm going to give you the copy of this. Looks like I'm wrapping up a little bit on the early side.
Hey, Barry, the food is not here.
Okay.
The delivery guy got lost, so we might want to do some Q&A.
Okay, good, good.
So the lunches will be here, so I'd recommend some Q&A until he gets here.
Okay, let's do that. So any of these concepts that I move past too fast, what we're going to do is just get some questions and answers from you. I'd love to have you. We've got lunch coming in, so you can have lunch on us. Anything that I went over too quick that I didn't answer for you? Have any of you worked with an investor? Yes? Does most of what I'm saying here sound true to you? Yeah? Some of this stuff I wished I had learned before I worked with some of my investors, you know? That would have been great. So, no questions?
I have a question. Could you please explain what you do? You gave us the flyer,
Yes.
the non-stationary realtors, but I didn't catch it very well. Other than advice for investors, could you explain?
Yes. So, how many in the room are real estate agents? I do the same thing you guys do.
You're
I'm a real estate broker, but I don't act as a broker, I act as an agent, right? So I do, even though I have a broker's license, there's probably no way you'd get me to use it anymore. I find that it's much easier to hire a broker than it is to be a broker. So the cost of what my company, I hire a broker for almost nothing. So why would I be the broker? I get rid of that liability that way. So I sell houses, sell about 50 houses a year. Yeah.
Or tell any of your investors that want to sell their properties, motivation. I mean, if you're doing your calculation and you're like, man, it's really a bad time for them. Do you ever just tell them that? And you're like, I wouldn't sell right now. I mean, it's kind of a hard line to draw because it's like you want to make money, but
Right.
at the same time, you want to do them a benefit.
So just to make sure everybody heard that, if you want to, the question was, do you ever advise your clients not to sell when they come to you and they want to sell? Well, you have to remember, I think one thing is, going back to that motivation. A lot of people will sell properties that has nothing to do with whether the market's up or down, right? They might sell a property based on the market, on their need, right? They might need to have a certain amount of income right now. Like their kid's going to college and they got to pay the bill. You know, so you got to get to that first, is find out what their motivation is. And then, yeah, you need to tell them whether this is a good time to sell or not. Most of the time, you'll find that when an investor's selling, they're selling because they have a need. They're selling because there's something personal in their life. Because most of you, think about this, you have a golden goose. We call that golden goose an investment property. It's laying golden eggs every month. Every month, if you've got a good investment property, again, all investment properties should be cash flowing. So if you have a property that's not cash flowing, it's not really an investment property. We have another name for that. We call that a liability, right? It doesn't go in your asset column. It goes in your liability column, right? Just at least to your cash flow and your balance. On your balance sheet, it looks like an asset, but on your cash flow, it looks like a liability. So that person probably has a reason other than that. But if that was the case, I would tell them. Yeah, but I might tell them in another way. I might offer to buy it. And so if they're wanting to sell it, I'll buy it, no problem. But yes, you're right, it might not always be a good time.
I have a client that's I'm working with that wants to make an investment because he wants to save on his taxes.
Okay.
So what you just talked about, he kind of wants something that's going to give him more deductions.
Yes.
So how do I balance that between, well, he wants to make money eventually, but he also wants to save on taxes?
Right. So let's go back to that. Since we've got the time to do it, I'm going to walk you back to that slide where we had the 5 ways to make money. Right? Cash flow, equity growth, interest deduction, depreciation, and appreciation. Right? Does somebody have a calculator handy? So I won't do this math for you. So let's say that I buy an investment property for that gentleman. Let's just assume that gentleman has an income over $300,000, right? He's in the highest bracket, right? So that's going to be a 33% tax bracket, right? So let's say that he buys this property for $500,000. So $500,000 divided by 27.5.
We're 27.5.
Let me get the number first, and I'll tell you. What's the number? $500,000 by 27.5.
It's $118,181 and 81 cents.
118,000.
18,000.
18,000. Okay.
181.
So the IRS says that the value of that property depreciates by 18,000 every year. Okay. Now we know that it actually appreciates,
Right.
but the IRS says that because it's a investment, because it's a house, a 1 to 4 unit, not commercial, they say that that's going to depreciate, right? So that $18,000 of income counts as a deduction for them. So take the 18,000, whatever the number was exactly, and multiply that times 0.33. What is 0.33? That's his tax bracket, right? So every dollar of income that comes in to him gets taxed 33%. So 18,000 by 0.33 should be somewhere in the 60s, right?
5,454.
So 5,000, let's just say it's roughly $6,000. So that depreciation value to him, because he's in the highest tax bracket, is worth $6,000 against income, right? So now let's go back to that again. $500,000, he put down 20%, so he put down $100,000, right? So for $100,000, he got a 6% depreciation, and a $6,000 worth of value to him. So 6,000 divided by the 100, that's 6%, right? So he might think he's getting 8% return because that's what he's getting on his cash, on his cap rate. But now you add in that 6%. Now I'm at 14. Now I'm at 14%. You see how I'm getting that 15% now?
Yes.
My preferred return.
Beautiful.
That's only one of the 5. Right? So his cash flow is going to give him a percentage, probably a few percentage points. His equity growth is going to give him a few percentage points because 30% of his money is being paid down on that note. And then this interest deduction is going to give him another. The interest deduction works the same way. You've got the interest, which was 30% of his payment. Let's say his payment was $4,000, right? So if his payment's $4,000, he's got 70% of that payment going towards interest. So what is that? 4,000 divided times 0.7. What is that? What is it? 2,800. So 2,800 a month is going towards that. 2,800 times 12.
33,600.
How much?
33,600.
33,600. So 33,600 times his tax bracket of 33%. That's going to be worth around $10,000, right? So now we got 10,000. Remember that 100,000 he spent? He just got another 10%. So now he's got 10% from that, 6% from the other, probably 3% from the cash flow. We haven't even got to the biggest one. Plus we've got equity growth. So the equity growth, remember the 30% that's going towards principal? That's his tenants are paying that equity growth. So we do the same math for that one and we come up with a number that's probably around 3%. The other one was 10. So now we're probably at close to 20% return for him. And we haven't even got to appreciation, which is the one everybody wants to talk about. Now the appreciation number is even more fun because appreciation, let's say it's 4%, right? But that's 4% against what number?
500.
Against the 500,000. So we're leveraged on appreciation, right? So now that's how you how you walk him through those 5 steps. So that's why his CPA is telling him he flat out should be out there getting some investment property. It's really a lot to do with that right there. Now, the other thing is, if you could get rid of the interest deduction by paying cash, that's always a good thing to do too. But you give up leverage, right? So that's a balancing act between those two. And you having it on a spreadsheet like the one I showed you to, lets you play with the numbers until you get the balance that he's looking for, right? Because what happens with leverage? You can over leverage yourself. And that's where it gets dangerous in real estate. It would be preferred that he never leverages more than 50 to 60, maybe 60% would be the good balance. A 40-60 balance. And most people are at a 75-25. Then when the market drops, as we saw it does, it dropped 50% and they were over leveraged. But if he's cash flowing, he never has to sell. That's number one rule. If you're cash flowing, you never have to sell your property. You can keep it forever. So as long as your net operating income covers all your expenses, you're good. That's why that term debt service coverage ratio was there. Debt service coverage ratio is used for commercial property. And a bank will not loan you money at any percentage down. You could put down 75%. And if the 25% left over doesn't cover your debt service at a 1.25 rate, they're not going to give you the loan, no matter how much money you have down. It's got a coverage of the debt service. So that's a good spot for us to remember for when we're working with our people. If they could get to 40% debt coverage ratio, that would lower the amount that they're leveraging. And as long as that hit their goals, remember those goals we talked about? How many cycles they needed to get to obtain their goal? As long as that hit their goal, then that's the right number. So now as you start to see, when you put all of this together, it allows you to really be a fiduciary for your client. It allows you to put them in a safe spot and let them make good decisions. Does that make sense? Any other questions?
You keep referring to cycles again. I don't understand when you say cycle. Is that annually, or are you speaking of some type of?
Yeah, no problem. Earlier, you might have missed it when you came in.
Yes.
Earlier, I talked about something called the Rule of 72.
No, I was asking.
Okay, so that's the cycle I'm talking about.
Okay.
So that Rule of 72 says you double your money in X number of years, right? So at 15% interest, you double your money in 4.8 years. I would call that one cycle, right? So there's one cycle. If they were getting 20% interest, that cycle would be shorter. Does that make sense?
Yes.
So guys, I come here just because I want to give back to you. I have been blessed to have worked with investors for a long time, and that's really helped me over my career. I've also been blessed with a friendship of a gentleman that has really taught me everything I knew in real estate. Of course, he didn't teach me about the investment part, but he did teach me how to sell. And I started working with Brent in 2001, and I started part-time. I was working for Hewlett-Packard at the time, and I've watched Brent over the years. I've learned so much from him. I've invited him down to share with you. We're going to give you lunch, and you can eat your lunch. If you have to stay, if you have to go, you can go. But I believe, just like I've shown you value, I think Brent's fixing to lay some value on you as well. He's going to tell you about a new real estate model that really, you've probably heard of it. It's changing the world of real estate as we know it. It's the fastest growing real estate company in the world. And feel free to bounce out if you got to go, but I think you're going to find it very interesting. And I hope you found my presentation interesting as well.
Thank you.
Thank
And we'll be done at 1 o'clock, right on time. Lunch is here, it's out in the hallway. The board of realtors here just had the carpets cleaned. So the secretaries are like, So apparently, we didn't know this. Food's right out in the hallway. And you can walk outside and enjoy your food, potato chips, water, whatever. Sourdough Sandwich Company did great sandwiches. And again, like Barry said, if you have to go, go. But for those of you who want to stick around, we'd love to meet you. I've sold 4,000 homes in 22 years.